Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
It has been the franking credits has been the limiting factor. So when a company does make a profit, it can pay it out as a dividend, or it can do a buyback. It can buy back its shares and create more capital gain, because if there's less shares, the earnings per share goes up, and that's normally good for capital gains. And when we ask the companies about how they choose whether to do a dividend or a buyback, they're all telling us that what they have been told by us and other investors is pay out a fully franked dividend first, but after that we don't particularly want unfranked dividends, that buybacks are the next best things.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. Is your portfolio designed for growth or income, or a little bit of both? What's the difference, and how can you work out what's right for your investment needs at this particular stage in your life? Joining me to tackle these questions is Michael Price. G'day, Michael.
G'day, Phil.
Thanks very much for coming on the podcast. It's great to meet you.
You're welcome. Thanks for having me.
Michael Price is Portfolio Manager of the Ausbil Active Dividend Income Fund. He has over 35 years of quantitative, actuarial and financial markets experience working in Sydney and Melbourne with companies such as AMP Capital, ING Investment Management, Mercantile Mutual and Colonial Mutual. Before joining Ausbil, Michael was head of Australian equities at AMP Capital. Now, Michael, we don't often have actual actuaries on the podcast. Can you tell us what an actuary actually does?
I can have a go. Actuaries are specialists at measuring and managing risk and uncertainty. We use statistics and modelling to assess risk and opportunities, and then trying to design solutions that manage that risk or take advantage of the opportunities.
And it's usually in the insurance industry, isn't it? That's where actuaries shine.
Yeah, actuary or insurance is the traditional field where actuaries sort of grew up and used that training. It's a lot broader now. Investment management is quite common. Data science is definitely an emerging field. But yeah, insurance was the original sort of employment field for most of the actuaries.
It's a funny word, risk, isn't it? I mean, we've covered this quite a bit on the podcast because there's a big difference between what ordinary people think is risk as opposed to what the finance industry considers to be risk. Do you find that as well?
Yeah, and I probably also distinguish between risk and uncertainty. So, yeah, the future is uncertain, but if you've got a plan in place, maybe it's not as risky as you might think. And managing a range of possible outcomes is definitely part of the actuarial training, but it's something, we all need to do.
I know. That's great, isn't it? The managing a range of possible outcomes. That's what investing's all about, isn't it?
Yeah, it is. The future is always going to be uncertain, and being able to survive no matter what is where you want to be. So you can certainly sleep a lot more at night with that uncertainty if you know you're going to be okay.
So I didn't realise that actuaries actually worked in investment management as well. But is this how you made the transition into investment management?
Yeah, it is. Look, it's changed a little bit since I started, but back when I qualified as an actuary, investment management was one of the 4 specialist subjects that you had to do, and it was certainly the one I was most interested in. It was the first one I tackled. My first role was with an insurance company, but what I was doing was what we called asset liability management, where we sort of have a look at the needs of clients, and I would try to find the appropriate investment assets which would match those needs or liabilities as closely as possible to reduce the risk of the uncertain outcomes. From there, I moved over into a quantitative investment management role. What that means is basically we do a whole lot of number crunching to select companies rather than basing the company and that or the company decisions on a deep underlying fundamental analysis. Yeah, it's much more number-based predominantly, and construct portfolios on the back of that. So I did that for a while, but then eventually was able to move over into a more traditional fundamental portfolio management role. So been lucky enough to work with a lot of good teams and large teams of people. We have analysts who build those bottom-up fundamental models of the company, and I get to concentrate on the sort of the top-down view of the world, thinking about what's going on in the economy and how we might invest on the back of that, and then create portfolios to meet client needs on the back of that. I've always specialised really in portfolios which have multiple objectives. So they're a little bit trickier to manage mathematically, and really able to go back and use some of my actuarial training and still able to do that.
Yeah, I like the term quantitative, and I had a guest on the program once and he said that quantitative is numbery and qualitative is feely.
Yeah, that's one way of looking at it. Look, they're both important parts of investment management. I mean, everybody, even the most fundamental guys, they still run some numbers, and certainly in Australia, all the quantitative teams have some fundamental understanding of what's going on, as well as crunching the numbers.
Now, I'm not sure if we actually met many, many years ago, because you used to work for Mercantile Mutual. I had a recording studio in the 90s in Surrey Hills, and Mercantile Mutual was one of my clients. And it was in the days of cassettes. You remember cassettes?
I do remember cassettes.
Did you ever work on any of those? You wouldn't even call them podcasts in those days, but they were released on cassette. Financial Information. Sandra Sully was the presenter of the things. And Graham Nicholson. You might remember Graham Nicholson.
Okay. Look, I wasn't getting out so much back then. The quantitative people were pretty much behind the scenes. So I was at Mercantile Mutual and then ING for 17 years. So time probably overlapped. But I don't recall going out and recording on cassettes.
No, it just seemed like a good company to work for. What was the name of the CEO? Rod
Attfield was
Rod
there.
Attfield, yeah.
Yeah. Mm. Yeah, as I said, 17 years, 17 good years at Mercantile Mutual / ING, and got to do lots of very interesting things, and ended up in what is really my current role was through them.
Okay, well, let's get back to what you're doing now, and that's a dividend fund. It's pretty self-explanatory, but tell us about a dividend fund. What's it designed for?
Yeah, look, it's designed for people who actually care about the split between income and growth, rather than just focus on the total return, sort of obviously, but not everyone is like that. And having done that, they want more of their return in the form of income. So typically they're investors where part of their assets, they want to live off the income and not touch that capital. Look, in theory, people should only worry about the total return, and they should just sell down a little bit of their assets if they need some extra income. But in practice, life is just so much easier if you don't have to do that, if you don't have to worry about whether today you should sell down or how much you should sell down. So in practice, there's definitely, I think, a need for dividend income funds. Look, now it might sound fairly simple and straightforward, but the interesting thing is, if you have a look in the marketplace, most of the dividend funds have slightly different objectives. They don't all agree on just how much extra income is desirable. They don't agree on whether or not you need to give up capital return in order to get that income. Some place significant value on franking credits where others don't. Some sort of give up some total return in order to lower risk. And they also use different techniques to get the extra income. So, it's quite a complicated area. And again, the sort of thing I like doing, and I've sort of got that training in. But the one thing they do all have in common is that they are trying to get more income to investors than the broader market. What's
the model client for your fund?
Yeah, look, the model client, interestingly, is almost, or in some sense, what you might call an investment foundation, that I have managed money for foundations, which they're perpetuities. They're going to live forever. So they really are never going to touch that capital, and they are just going to live off the income indefinitely. And so that would be the perfect client. But I think most people have at least a slice of their assets where they want to live off the income, get as much income as possible from that, but still have access to that capital, whether it's for a contingency, something that comes up unexpectedly, or aged care, healthcare are obvious ones for older people. passing it on as a bequest if that becomes possible. So, yeah, we do have a lot of interest from retirees, but there's a lot broader application, and not necessarily you put everything into a dividend income fund, but having a slice of those assets or slice of your assets which have that particular objective, I think many people would have that.
So what's the makeup of the fund? What comprises the fund? What sort of assets?
It's an Australian share fund, so it only invests in Australian shares. It's predominantly larger Australian shares, although Ausbil, the company I work for, does have a good team looking at smaller companies and emerging companies, but really we're looking at about the top 500 shares in the Australian marketplace. So each year we try to distribute between 7 and 8% per annum. So that's after fees, but including franking credits. So we'll probably talk more about franking credits later, but they're very important for the fund. But when the fund was being developed, and I was being interviewed by Ausbil, the head of marketing made it very clear that some people care about this split between income and capital, but no one actually wants a lower return. And Ausbil has a track record of outperforming the market and delivering alpha as on top of the market return. And so that was the challenge they gave me, that could I come up with an equity income fund that delivered that 7 to 8% distribution each year, but still outperformed the total market as well. And that's what the Ausbil Dividend Income Fund's all about.
Well, that's a bit of a tightrope walk for you, isn't it?
It is a challenge, but that's what I enjoy doing.
So you're trying to achieve better dividend returns, but also provide capital growth as well. Is that what I'm hearing?
Yes, very much capital growth is important. Again, if we think back about the ideal investor, if you're going to live off your income indefinitely, that income needs to grow with inflation over time and have some capital growth. And really, to do that, the capital needs to grow as well. So if the 7% can stay the same, but as long as the capital is growing over time, then the income should keep up with inflation. This was certainly something we talked about before the fund was launched, what the right number was. So the 7 to 8%, part of the way we get there is, when I think about the long-term return from the Australian equity market, after fees, including franking credits, maybe a little bit of value add, 10% seems like a pretty common number. So if we're doing 7 to 8 in income, that leaves 2 to 3% for capital growth. And 2 to 3% is the Reserve Bank target for inflation. It hasn't been within that band for most of the last 10 years, but at least in the long term, I think we can expect inflation in that 2 to 3% range. So, look, even though the market isn't going to do 10% year in, year out, if it can average that over time, and inflation's not going to do 2 to 3 year in, year out, but it can average that over time, then 7 to 8% income leaves 2 to 3% capital, and the fund can deliver an income stream which grows with inflation over time.
So does that mean that you're paying out the 7 or 8%? But then the funds that remain in the fund grow over a period of time? Is that how it works? Or is it all kind of bundled up together?
No, that's exactly how it works. The distributions come out, and then it seems obvious, but you've only got your total return to play with, and your capital growth is the difference between your total return and the income that you distribute. There have been equity income funds in the past which have distributed 10% plus and used techniques which meant that the total return was over 5. And it took people a little bit of time to realise that meant that the capital is not growing over time. It has to be going the other way. Whereas, the way we've designed it is, to get that capital and growth as well. It's why the outperformance is important. If the market's doing 9 without any outperformance, and if you're underperforming and only doing 7 to 8 and distributing 7 to 8, it's not going to grow. And so it is a key part of the process and the fund objectives.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
I remember investing in an ETF at one stage, and it was an income ETF or a dividend ETF, and I couldn't believe it. It just didn't have any growth over time whatsoever. So obviously you're trying to do the right thing there.
How much income were you getting?
I can't even remember. It was a long time ago. I got out of that one and just went into another kind of index fund.
Okay.
So we've heard the term dividend harvesting on this podcast. Can you explain what dividend harvesting is, and is it a strategy that's used by your fund?
Yeah, look, dividend harvesting's simply about buying a company just for the dividend. And so you buy a company before it pays the dividend, you wait till it pays the dividend, and then you sell it afterwards, waiting for 45 days if you want the franking credit as well. Look, it is a good way to get income, but it's not so good for total return, both if you're out of the market, which there have been some ETFs like that where they kept you out of the market, so the total return is more in line with cash than the Australian equity market. Or if you're buying it without knowing much about the company, you can get that extra income, but if the company goes backwards, you can lose a lot more on capital than you get in extra income.
Yeah, it's one of those things that sounds good in theory, doesn't it? But practically, if you try and do it yourself without any expertise, it can really bite you.
Yeah, it can. But that said, it is closely related to what the fund does, which is actually what I think is the best way for a portfolio to get extra income out of the portfolio. So the idea behind the fund is it takes advantage of the fact that not every company pays its dividend on the same day to collect more dividends over the year rather than higher dividends. By that, if you think about the alternative, collecting higher dividends, if you want to get 7 to 8% after fees on all your stocks, if you have a look at the companies that have dividends that high, they tend not to be great for total return. So buying higher dividend stocks, good for income, not so good for total return. So what the fund does is it only holds companies that we like, that pass our stock selection screen, that the analysts all approve of, that we'd be happy to hold for the long term. And we create a portfolio that if the market shut down, I'd be happy to hold for the next year. Typically, the dividend yield on that portfolio is around the same as the market because it is trying to be broadly the same shape as the market and outperform the market. But what I do is, having got that portfolio, I have a look at which of the securities in that portfolio are going to pay a dividend over the next month or two. And then I increase the weight of those companies which have an upcoming dividend and reduce the weight of the companies that are most similar, sort of thematically, statistically, again, getting back to the quantitative training, try and keep the overall shape of the portfolio as consistent as possible with what we want, but collect extra dividends as those dividend payment dates come by. And the way the numbers work, it needs to be about 10% of the portfolio. If I increase the weight of about 10% of the portfolio when it's got an upcoming dividend, there's 8 months in the year where at least 10% of the dividends get paid or 10% of the companies pay their dividends. So you've got 8 opportunities a year. And 10% of the portfolio, 8 times a year, gets you about 50% more dividends than the market and allows you to meet the objectives of the fund. So
a little bit like surfing a wave, I guess, isn't it?
Yeah, or going back in time, graphic equalizer. Did you have one of those in your studio?
I've got digital ones.
So we push up the weight of the stocks with the upcoming dividends and then reduce the weights of the ones that don't but are as similar as possible, and get the extra dividend income that way.
Yeah, a parametric equalizer for any of those audio nerds who might be listening.
Sorry, my mistake.
No. I was just specifying what kind of equalizer.
I'm a different kind of nerd, yeah.
We're all nerds in our own special way, aren't we?
In our area of expertise, yeah.
That's right. Look, I was watching a video from about a year ago where you mentioned that the fund is style unconstrained. What does this actually mean?
Look, all it means is the fund doesn't restrict itself to both to either value companies or growth companies, but it's happy to hold both. So Ausbil's investment philosophy since the day it was launched was that it's all about earnings and earnings revisions that drive share prices. And what we mean by that is that expensive high growth companies can continue to outperform as long as they deliver on their earnings. And while cheap value-based companies will continue to disappoint until their earnings turn around. What really matter is those earnings revisions and whether a company can meet or exceed expectations of the market. And you can find those earnings revisions in value companies or growth companies. So, and sometimes there's more in the value space and sometimes there's more in the growth space. So by being style unconstrained, we can take advantage of all the opportunities. We should be able to outperform in all types of market and have a broader portfolio which doesn't have a strong style bias to either value or growth.
What about franking credits? Do they play any role in the strategy and do they get paid out to investors?
Yeah, look, franking credits are really, really important. People often think about franking credits as just for retirees, but in fact, a dollar of franking credit is worth the same as a dollar of cash to all Australian taxpayers. So, it's just one of those strange things that we don't really pay that much attention to them when it comes to returns. Now, the Australian market is about 1/3 owned by offshore investors, and for them, the franking credits don't have any value, or have very little value, maybe a little bit on the withholding tax. But what that means is a real opportunity for Australian-based investors to really pick up those franking credits at a very, very cheap price. They're basically not correctly valued by the market. So, look, with the extra income that the fund collects over the year, it can typically get about 1% or close to 1% each year in extra franking credits, so over and above that of the market. And basically gets that without any cost at all, apart from a little bit of hard work and a little bit of brokerage through the algorithmic systems, which are very cheap for a company of our size. So, look, in fact, that's the secret sauce behind the fund. I mean, you might be thinking, well, how on earth can you get the same total return as the core Australian equity fund if you're going to get that extra income as well? And the secret is the franking credits. It's that extra 1% you get from franking credits, that what you might lose on a cash basis from that 10% of the fund, which is getting increased in weight around the dividends, you get back that, and often you get back more from the franking credits.
Well, let's zoom out a little bit to the macro. And again, I'm referring to the video that I watched a couple of days ago, and it was from about a year ago, and you were still talking about quite a highly inflationary environment. But now, well, we seem to be in a disinflationary environment. Do you think it's sustainable? And how is this affecting investment decisions for the fund?
Yeah, look, I think inflation will get back to within those bands, that the 2 to 3% that the Australian Reserve Bank has, and 2% over in the US. However, I do think it'll probably be at the top end of that range. I don't think it's going to get below that for a sustainable period of time like we experienced a decade ago and lasted for close to 10 years. A couple of reasons for that. So, one is the Australian Reserve Bank in particular, very proud of the really strong employment record that we have, record levels of employment, and they've indicated that they're happy for inflation to be slightly higher or towards the top end of that band, as long as people don't lose their jobs. And so because of that, inflation should stay will be towards the top end of the band. The other thing is that our house view, we have a full-time chief economist looking at the world, and we certainly believe that the US is particularly strong at the moment, and that will allow Australia to recover as well, from a bit of a beneficiary of some of these interest rate cuts. And so we think recessionary fears around the world are definitely overblown, and in fact growth will be stronger this year or the year ahead than it has been in the past. So a combination of a Reserve Bank which is happy to allow inflation being higher and growth being stronger than people expect means that we think inflation will be at the top end of the range. Now, look, as I've said, the investment process for the fund, it does actually start with a top-down view of the world and the economic outlook. We then try and identify attractive sectors and themes to invest in on the back of that top-down view. So lower inflation does allow for lower interest rates, and that is good for companies that are exposed to growth in the economy, and that's how we're trying to position the fund at the moment.
You and I are old enough to remember what the days of inflation, real inflation, was like, and what interest rates, the kind of levels that they had to go to. Do you think something's fundamental? I know you're not an economist, but what's your feeling? There's something fundamentally changed that raising interest rates doesn't seem to be having an impact on employment?
It's certainly surprised central banks. To get technical, their NAIRU, their non-inflation accelerating rate of unemployment estimate, I think they're coming around to admitting it might have been too high, that the economy can cope with lower unemployment and still not be inflationary. It's the challenge for all actuaries and for investment managers is always asking how good a predictor of the future is the past, that has something fundamentally changed or not. And I do think that labour markets probably more efficient might be the sort of the positive word, that less secure would be the negative word, but it does mean that people, if they do lose their job, get another one fairly quickly, and that allows unemployment to be lower in the longer term. So, that would be my take on it.
I like giving surprise questions like that. You really had to think about that one, didn't you?
Yeah. Well, look, it is something we do think about. It's something which has really come up this week. The Reserve Bank saying they think they got their estimate of how much or how inflationary full employment would be wrong, and they're trying to understand why they got that wrong, and they've been thinking about it themselves.
Okay, well, getting back to the questions, what are the sectors you see doing well in 2025 and given the interesting times in which we live?
Yeah, well, look, one of the best parts of this job is times are always pretty interesting. There always seems to be something going on. Look, right now our top-down view is based on stable bond rates, a strong US economy, and this upswing in cyclical growth. So that means we're looking for cyclical companies that are beneficiaries of a stronger economy, beneficiaries of US strength. So we're looking at resource companies, we're looking at some of these US-based earners, offshore earners, looking at companies that are exposed to the housing cycles, so sort of steel, building materials, maybe even some consumer discretionary as well. So, they're the sectors we think will be most attractive over the next 12 months.
Do you think resource companies are going to be able to maintain the level of dividends that they've been providing over the last few years? Because they've been great dividend earners, but that can turn on a dime, can't it?
Yeah, it can, and in fact, it has. So just in the last couple of weeks, all the major miners have substantially lowered their dividends from a couple of years ago. Interestingly, I think it was 2 years ago that the 3 iron ore companies paid more dividends than the 4 major banks, whereas this year it'll probably be back to being about half the major banks. So, look, I think that's important for investors when you have a look at, one of the things I like saying is I think it's easier to meet objectives, or a portfolio can meet objectives that individual stocks can't. So you can get some short-term very high dividends from individual stocks, but it really is just very hard to maintain that over time. I think we're still going to get reasonable dividends out of the resource companies. BHP reassured me just a couple of days ago that they're always going to pay 50% of their profit in dividends no matter what, but they will be a lot less than what we were used to when the iron ore price was incredibly high.
Is that something that you pay attention to, the dividend payout ratio? I mean, like the banks, what are they paying, like 80% or something like that? We do pay attention to the payout ratio. Look, it's to do with the sustainability of the dividends and predicting how likely they are to grow in future. The big thing for us, because we're not this passive buy and hold forever. We do have getting this extra income by rotating around the dividend dates. So, it's not essential for us that a dividend gets maintained, but if it's going to disappoint the market expectations, that's never going to be a good thing. So understanding payout ratios and whether they're sustainable is a very important question. And we again had discussions with the banks recently. A company like Telstra is another interesting one, really paying out everything it can is something we talk about. Actually, just one interesting point is that for the banks and for Telstra, it has been the franking credits has been the limiting factor. So
So when a company does make a profit, it can pay it out as a dividend, or it can do a buyback. It can buy back its shares and create more capital gain, because if there's less shares, the earnings per share goes up, and that's normally good for capital gains. And when we ask the companies about how they choose whether to do a dividend or a buyback, they're all telling us that what they have been told by us and other investors is pay out a fully franked dividend first, but after that we don't particularly want unfranked dividends, that buybacks are the next best thing. So yeah, this is all part of the analysis that we're doing on the companies.
It's a lot of moving parts, isn't it? And I guess just speaking about dividend payout ratio and BHP assuring you that they're going to pay out 50% on a continuing basis, but that 50% can be of a figure that can be quite a lot more volatile than, say, a bank or a Telstra.
It certainly can. So yeah, the latest one is less than half what it was a couple of years ago. So yeah, it's definitely not as reliable. Again, the advantage of a portfolio. Interesting though, you might mention banks as stable dividends. How soon we forget the pandemic when the banks all skipped a dividend for a half year. So yeah, the banks also, as a collective, I think lowered their dividends by 75% during the pandemic. We have seen resource companies lower their dividends by 75% from peak to trough the last time we had a big resource cycle, and that potentially happening again. So yeah, it's all about the risks of individual stocks, which is why I think offering a portfolio can provide that protection which individual stocks can't.
So tell us, and of course past performance is no guarantee of future returns, but tell us about the fund and how it's performed over time.
Yeah, so look, the fund's nearly been around 7 years now, and yeah, extremely happy with the performance. So after fees and including franking credits, it has comfortably outperformed the broader market or the index, and it has been able to deliver that 7% plus distribution every year, again after fees, including franking credits, and it was able to do it during the pandemic, which it was really pleasing. That when the fund was launched, I said 7% to 8% was my expectation of what we could deliver. If we had another GFC, I think we could do 7%, and that was about the minimum. It turned out during the pandemic, dividends per share dropped by 33%. It was only 30 during the GFC, so it was a slightly bigger drop, and we were still able to get there. So now people are a lot more comfortable letting me say that I'm pretty confident that we can deliver that 7% to 8 in future, as well as the 6 full financial years that we've had so far. There is one thing I probably should have mentioned about the distributions.
Please tell us, yeah.
And again, one of the benefits of a fund rather than in individual securities is that we are able to smooth these distributions over the year as well. So at the start of the financial year, after the first month, and the other thing is we are able to pay them monthly rather than half yearly like many other funds, or quite lumpy like if you're holding your shares directly. So at the end of the first month of the financial year, end of July, we announce a cents per unit, and the expectation, not guarantee, but the expectation is that cents per unit will be able to pay exactly the same amount for the first 11 months of the financial year. Now, it is a trust, so at the end of the year, we do have to pay out the balance of the income, so you get normally a little bit extra on top of that at the end of the year, and then you put in your tax return and you get your franking credits after that. But we are able to smooth this income as well across the year. So yeah, not only is it much higher than the market, it's also a much smoother income stream than the market. So getting back to your first question about the typical investor, someone who does want to live off the income, well, you want to know how much income you're going to get every month, and you want to know it's going to get there. And yeah, that's another feature of the fund we've been able to provide.
So Michael, how can listeners and viewers find out more about Ausbil and the fund?
Go to our website, www.ausbil.com.au. There'll be a PDS there where you can read about.
Michael Price, thank you very much for joining me today.
Thank you very much for having me, Phil. Appreciate it.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.